Good afternoon. My name is Khanyisile Malebe, an investment analyst at 274 Investment Managers. Today, we'll be looking at the key highlights from the budget speech presented by Finance Minister Enoch Godongwan. In terms of revenue, we have seen higher revenues from personal income tax as well as value added tax, and in corporate tax from mining companies as a result of higher commodity prices. This allowed the finance minister to allocate a 5.2 billion rand tax relief to provide ease to the public and companies. In terms of expenditure, there was an overall increase of only 3.86% in total expenditure, which is lower than the increase that we had in 2021. And of that, 59.4% was allocated to the social wage. The budget deficit is expected to improve by 2024, and the other key highlights are the public wage bill is expected to increase at inflation levels, and the SA economic growth is expected to be 4.8%, while real GDP is expected to grow by 2.1% in 2022. Thank you. I will now hand over to Orin.
Thank you very much, Kanye, for that introduction. Now, I think the question in a lot of viewers' minds is what does this mean for them and what does it mean for us as a country? Before we actually answer that question, I just want us to sort of paint a macroeconomic picture in terms of where we're coming from. So essentially, one of the issues that I've been struggling with is the fiscal slippage. The government has essentially been living beyond its means in the sense that it has been spending more than the revenue that has been collecting. And as a result, our debt levels have skyrocketed quite significantly over that period of time, and we're at a point where we're struggling to pay that back. The second issue is that we have struggled to grow the economy robustly, so we're sort of trapped in a low economic growth and a conundrum for the country. When you look at some of the projections that we're getting from several economists, is that the country, given the level of unemployment that we are currently having as a country, we need to grow at about 5%, per annum, but we've been growing at way lower than that. So that's the second issue. The third issue, obviously, is the issue of COVID-19. It has exacerbated some of the problems that we have already been having as a country. The fourth issue is because of the high debt levels and the poor economic growth, we have seen our debt being downgraded significantly by several credit rating agencies, and that is essentially resulting in us paying more for the debt that we are borrowing at this point in time. The fifth issue is the fact that there's been quite a lot of populist calls that we've been seeing from the market. Some of them essentially saying we should be starting the basic income grant, others saying that we should continue borrowing for us to be able to support economic growth. So I would say that is pretty much the macroeconomic picture that we're coming from. Now the question is, does this particular budget talk to some of those issues? We do believe that it does talk to some of them, but we were not expecting it to solve all the problems that we're having as a country. So one of the issues that we found to have been positive from this particular budget is the fact that the National Treasury managed to toe the fiscal consolidation line. So when you look at the projected expenditure, that is expected to be contained. The public wage bill, which has been one of the biggest issues that we have been struggling with, is also expected to remain pretty much flat over the next 3 years. There's no new allocation, that has been given to SOEs. We understand that SOEs have been, one of the biggest areas whereby some of the revenue that the government has been collecting has been going to, and as a result, it is also essentially helping in the deterioration of the government balance sheet. There's also no mention of the basic income grant. We understand that there were some calls within the ANC for the government to start introducing the basic income grant, which could have been detrimental. We can see from this particular budget that the National Treasury did not include that in its expenditure framework. So those are some of the good things. So now, when you couple those sort of very disciplined expenditure estimates with some of the improvements in terms of the revenue collections, it essentially means that the balance sheet of the government is going to improve slightly over the medium term. For instance, the budget deficit is expected to narrow down from around close to 6% currently to around 4.2%. The debt to GDP is also expected to stabilize at around 75%, quicker than what was expected about a year ago. So we think that's one of the major positives that we can take away from this budget. The second positive as well is the fact that I've mentioned that we're essentially in the middle of a health crisis which was caused by COVID-19. What is the government doing to try and alleviate the pressures from consumers? So they didn't increase taxes, which is quite a good thing. We're also noticing that the government has decided to extend the COVID-19 relief, which is being given to those people that are affected by COVID-19. So all of those things, we believe that they're positive for consumer spending, which is also going to trickle to some of the companies that plays within that particular segment in the economy. So those are some of the key issues. But again, it's not all good. We believe that one of the key issues that we continuously monitor and that we feel that is not being given enough attention is in terms of the amount of money that's being directed towards capital assets. We continue to see that the proportion of capital assets as a percentage of the total government revenue continues to pretty much remain flat, and it's also expected to be pretty much flat over the medium term. So that's one of the issues. And again, we are also concerned by the fact that yes, we understand that debt levels are going to stabilize, but we still feel that that it's going to remain unsustainable for the country. It means that over the medium term, over the next 3 years, around 20% of government revenue is going to be spent on servicing the debt. That money could have been used for other things. Could have been directed towards social services. It could have been directed towards capital projects that eventually could boost economic growth. So I think in a nutshell, we see that the ministers try to balance quite a lot of conflicting interests from various stakeholders. I think they've done that quite well. We believe that it's going to be his budget is going to be viewed positively by the rating agencies. So at the end of the day, we think that it's going to be quite good for our bonds. It's going to be good for the rand. We, however, don't think that it's going to do so much when it comes to equities, because what companies need is to have robust economic growth. We believe that at this point, the catalyst for us to start growing at higher levels doesn't lie with the National Treasury, but it lies with the government implementing the reforms that were mentioned by the President during the State of the Nation address.